It's kind of hard to know the operations of a particular large multinational corporation. And so that's part of the reason why I personally don't own any publicly traded company, simply because I cannot really know whether my investment is a no harm investment.
Today's guest used to manage emerging market equities at a respected investment firm until he realized that his investments were doing too much harm to the environment. Welcome to the Inspired Money Podcast, where we explore positive money stories. I'm Andy, host and financial advisor at Runnymede Capital Management. If you want to shift your perspectives on money and use your money for good to make a bigger impact, welcome to the Inspired Money channel, where you get interviews and money tips. Now, we've talked about making investments that are aligned with our values in the past, but would you consider selling your entire portfolio today, your 401k, IRA, all of your investments, so you could be a 100% aware and no harm investor? That means knowing what you own and knowing how your investments affect the world that we live in. Today's guest, Marco Vangelisti, did that and more. He left a 20-year career in finance, sold his personal portfolio, and transformed it. In this episode, you'll learn some of the problems with owning a mutual fund and popular ETFs like the S&P 500, how Marco transformed his investments from traditional to aware and no harm, and investing for good rather than optimal returns. Now let's get inspired with Marco Vangelisti. Marco, welcome to Inspired Money. I'm so excited to have you on the show.
Thank you, Andy, for inviting me.
Let's jump right in. What's your earliest childhood memory of money?
My earliest childhood memory of money was my grandfather giving me a beautiful, heavy 100 Lira coin, which is really a work of art, and it's so solid. And to me, it translated into 2 ice creams. So that was like, I felt very rich. And that's the first memory I have of money.
And specifically gelato. So even
not
richer.
Exactly. Not that, run-of-the-mill ice cream. We're talking about Italian gelato. So it's a special experience.
I dream about gelato frequently. Marco, you've been an investor for a very long time. Who were the investors that initially inspired you to start a career in investing?
Well, I'm always saying that I'm an accidental tourist in the land of conventional finance. And my journey started, I'm a mathematician, and I came to Berkeley to study economics and finance. And then I stumbled upon this little boutique shop that in the mid-'80s was developing quantitative models for the quants in Wall Street. I don't know if you remember the mid-'80s. You might maybe be too young for that. But at the time, we didn't have, PCs. We didn't have emails. We didn't have cell phones. I mean, just think about that. And we were working on mainframe computers to develop quantitative models for the quants in Wall Street. So as a mathematician and a statistician, that's where I found my place. So it's not that I got into finance because I was inspired by a particular investor. It was just a place where I could use my mathematical skills. And then over time, I took various detours, and my last stint in finance was with a investment management firm, and I was part of a team managing $20 billion in emerging markets equities. So that's, to a certain extent, my bona fide accreditation to be on your show.
I was not in the workforce in the early 1980s, but I'm very familiar with mainframes and not having cell phones. My father was in the business then, so I recall him having these HP plotters that had little pens and could actually draw charts, and that was quite something at that time.
Right.
For you, since you were the accidental tourist and investor coming at this from the mathematician standpoint, at what point do you go from modeling, like from quant models, to thinking about what impact are are these investments having on the world? Maybe you can take us through your career a little bit and tell us when you begin to see that, when you begin to see things that cause you to eventually become this no harm investor today.
Right. Well, to a certain extent, finance can abstract from the natural environment and reality, right? It's all abstracted. And what we pay attention to is risk, return, and liquidity. And that's all you need to know to make an investment decision, right? The problem is that investments happen in a reality within a society, and investment could have real life impacts. And I guess when my moment of realization that finance could be quite damaging and devastating was when I was part of this team managing $20 billion in emerging markets equities. We were doing great. We were basically the mutual fund that had the best 10-year track record worldwide in that space, emerging markets equities. And just imagine, outperforming the benchmark by 13% 1 year with a long only unleveraged, $20 billion portfolio. So we were doing our quantitative models were working very, very well. And, we had a very quantitative process to put together a very diversified portfolio of stocks. We had between 300 and 500 stocks in the portfolio. And at a certain point, I asked myself, okay, how do we get that amazing performance that year? And by digging a little bit deeper, I found that we were holding a couple of palm oil companies in Malaysia that had just destroyed the habitat of the orangutans. Tens of thousands of acres of forest were destroyed, were replaced with a monocrop of palm oil plants. And one of the reasons why those companies were doing very well is because they got a lot of carbon credits in the process, because they were planting trees. And so here I was, a committed environmentalist. The other thing that your listener needs to know is that a lot of the clients, our clients at the time, were foundations and endowments, including environmental foundations. In fact, some very well-known environmental foundations that I had contributed because of their great work saving the habitat of the orangutan. And here I was finding myself in my professional capacity, managing the same money and investing it in a company that destroyed the very habitat those foundations were created to protect. And that was my realization moment that made me realize we have to go beyond risk, return, and liquidity. We really have to pay attention to what our investments are doing out there in the world. So that's when I left the industry, because I felt I really couldn't be part of this. And, the financial system is so opaque and intermediated that it's very hard for an individual to know what their money is doing out there in the world, really.
Can you incorporate some of the criteria into a quantitative model that would help to solve for some of those issues?
The answer is no. Every time you have a quantitative model, look at the situation now, right? We do have a lot of mutual funds that invest in publicly traded companies, and we do have rating companies now trying to come up with criteria and say, how well is that particular company operating in terms of their relationship with the environment, with governance, with the society at large? And so you could say, yes, now we have these third-party entities that can let us know how well those companies are doing along those dimensions. But it is a very imperfect job. And I want to give you an example. You probably know the company Cisco. Cisco is a food distributor. And I remember a couple of years ago going to a festival, movie festival, and the best movie that year was called Ghost Fleet. And it was telling the horrendous story of slave labor in fishing vessels in Indonesia and Malaysia. And basically they were kidnapping people, and then they were slaves on these boats, and they would work them to death and not paying them anything, of course, because they were slaves. And guess what? After the movie came out, it turns out that those vessels were in the supply chain of Cisco. which otherwise ranked pretty well according to ESG criteria, because to a certain extent, maybe they had a diverse board and they were using fluorescent lights in their offices and recycle paper. You see what I mean? So it's kind of hard to know really the operations of a particular large multinational corporation. And so that's part of the reason why I personally don't own any publicly traded company, simply because I cannot really know whether my investment is a no harm investment, which is, what I've been committed to.
Wow. So you made some quite drastic decisions. One is leaving a well-paying job at a well-respected investing institution. And two, you liquidated your personal investments as well.
I have to make a confession, though, and that's shed some light into the complexity of what we're dealing with. I left the finance industry in 2009, and the loss of a very nice income was way larger than any loss in financial returns I might have caused by, let's say, liquidating my portfolio. And yet it took me 3 years longer to completely align my investments with my values than it was in aligning my livelihood with my values. So in other words, I could see what I was doing with my job. I left and said, no, I don't want to be part of that. But for another 3 years, I was still participating in global finance through my portfolio. And I was thinking, well, once I liquidated my portfolio and let's say I lost a little bit of return, obviously I haven't been in the market since 2011, and the market has done quite well, thank you very much, since then, right? But that loss is really a rounding error compared to, the loss of an income working for a financial company like the investment management firm I was working for. So my question is, why was it easier for me to absorb a financial loss that was about 100 times greater than the loss of losing return from my portfolio, right? And it was easier because we live in a very complex, opaque, intermediated financial world where it's very hard to connect the dots. It's very hard for us to know how are we acting in the world through our investments. It might be easier for us to know how we act in the world through our work. And we can say, oh, I don't want to be part of this, right? But it's much harder to look into our investments and figure out, are they aligned with our values or not? And, is ESG screening enough to say, I'm good?
Since you don't own any publicly traded companies, your answer sounds to be no. Screening is not good enough.
Well, I don't want to say that ESG is not worth something. It is absolutely essential. So I'm so thrilled that we have ESG screening, that companies are pushed because of it towards practices that are less damaging. So absolutely, I think that's great. What I'm saying is that if people want to really go deeper, they need to really know what they're holding, what they own. And, if I were to ask, for example, the regular Joe, do you own Huntington Ingalls Industries? They wouldn't know. They probably don't even know what Huntington Ingalls Industries do, right?
So you have to tell
them.
them.
Actually, right, they are the largest military shipbuilding company in the United States, and they have aircraft carriers, nuclear power, submarines, and so on. And if you own an S&P index fund, you own Huntington Ingalls Industries, right? And for every nuclear-powered submarine they sell, you make some money. You benefit from that. And yet, very few people would know about that because it's hard to kind of peer into through the veils of intermediation to know exactly what people own.
It is complicated. And as you said, in your job, it's easier to have more insight into whether or not you're having a positive or a negative impact. With your investments, there are so many layers that it's very difficult. How difficult was it for you to leave your job, since that paycheck, you say that is like that was significant to give up.
Yeah. Well, I must say that I have missed receiving every 2 weeks a nice check. And I can also tell that teaching courses on aware no harm investing is, although shocking to hear, not as profitable as working for a $20 billion emerging markets equity fund. But at a certain point, I couldn't really be part of this game. I thought, what are we doing here? We have environmental foundations that are trying to do good, but they have two departments. They have the investment department and they have the program department. So the program department gives away 5% to do really good things. And the investment department is trying to maximize or at least, grow and preserve in perpetuity this capital without really asking a lot of questions as to how this capital is deployed, as long as it provides good returns. And so that disconnect was just a little bit too much for me to stomach. So I had to leave the industry. And it's interesting because, after that, I basically was trying to figure out how do these large systems work? So I wanted to understand, how did we have the financial crisis of 2007, 2008? And, not many people know that was a collapse of the shadow banking system. And very few people know about banking, and even fewer people know about shadow banking. But it's basically the chain of intermediation that takes you from mortgage issuance to tradable securities on Wall Street, and that process basically collapsed. And so I started looking at the banking system and the financial system and the economic system, and I started talking about it in terms that everybody could understand. So I was trying to kind of democratize that understanding of large systems, because I believe they function as an operating system of society. And if we really want to bring about a society that is more fair, more just, and in balance with nature, we need to understand how those systems work, and we need to feel empowered to challenge them and maybe redesign them.
How do you know what to do after you leave your job? Is it you're trying to do a study to understand the structure better of how you can invest your dollars to align with your values and your mission?
Well, when I left the industry, I was not really thinking about investments at all. That's why it took me 3 years to rebalance my portfolio. I joined all sorts of movements. For one, the slow money movement. I was one of the founding members of Slow Money. By the way, Slow Money is an effort to use money locally with the ultimate goal of restoring the fertility of the soil close to where you live. So that's basically what Slow Money is about. I joined the public banking movement. I joined, Occupy Wall Street. I joined the permaculture movement, the transition town movement. I got a permaculture design certificate. I was trying to expand my understanding of the world. And so it is in that process that I realized a lot of the people that wanted to change those systems did not understand them very well. A lot of the people that might be protesting Monsanto might not have gone to business school, or might not have, had a fairly strong finance background.
So you brought a unique perspective.
Yes. So I was certainly a unique voice in the movement.
So it doesn't sound like you were not busy.
No.
You were signing up for a lot of different organizations and becoming involved. How does that evolve? Like, take us through that process a little bit more.
Well, first of all, it starts with, I went to a conference. It was called the Economic of Peace Conference, where I met Woody Tash, who is the founder of Slow Money. I also met a number of people involved in the public banking movement, and I met a couple of collaborators with whom we started the Slow Money Network in Northern California. So it was really exciting. I mean, I felt like I found my tribe, and so at the beginning was a lot of volunteering. In fact, Slow Money work is all volunteering, but over time, I started basically teaching what I was learning to those networks. And so I gave, for example, a seminar on how banking really works to the Public Banking Institute, because a lot of the activists had a little bit of a naive idea of how banking actually worked. And after a while, I realized that a lot of people, especially when I was talking about the financial system, would come to me and say, "Would you manage my money?" Because they knew that our values were aligned, and so they said, "Oh, and you have experience managing money, so why don't you manage my money?" And I would say, "No, I can't manage your money, because then I would be an intermediary. Then I would be held to standards like trying to maximize risk-adjusted return for you, you know." And so what I started doing is teaching people how to think about investing. So how to develop enough financial literacy to take responsibility at least for a portion of the portfolio. And I understand that it's hard to do what I've done and just liquidate everything and manage your own money on your own. That's why we have people like Andy Wong that can manage the money for you. But I am not a financial advisor. I do teach financial advisors, though, about this new space of, if you want, no harm, aware no harm investing. And of course, the next step then is impact and regenerative investing.
Can you tell us a little bit about how your personal portfolio was transformed?
Oh, yeah. So at the very beginning, what I did is I'm actually called an angel divester because, I divested completely. And it's super easy. People say, "Oh, it's so hard." No. That part is really easy. You just go on Schwab or whatever, you say, sell, sell, sell. And next day, you're all in cash. So it really super easy, right? What is hard is what to do now with that cash. And so the first thing I did is I parked quite a bit of it with RSF Social Finance Social Investment Fund. So RSF is a social investment company, it's a nonprofit based in San Francisco, inspired by the thinking of Rudolf Steiner. And they have this fund that they invest in amazing social enterprises around the United States, mostly in three sectors, agriculture and food, education and the arts. And so, investors can invest with them. It's basically like a money market fund. I mean, they have quarterly liquidities, it's very safe, they pay a little bit of interest. But the best part is the quarterly newsletters that make you feel so good about your investment. And by the way, this is open to everybody. I think the minimum investment is $1,000, if I remember correctly. But anyhow, so that's one way to park the money, because I didn't want to leave it in a bank. So I left the bank and I transferred my funds to a credit union and part of it to RSF Social Finance. And then after that, I basically started being very active with slow money. And so we were doing loans and investments in early stage companies, usually in the food and agricultural space, close to where I lived in Northern California. Now, those type of investments, I realized, are significantly risky, right? Because you make a loan to a farmer. A farmer can have a bad season and you might not see the money back. And so that's why, those type of investments, your financial advisors will never be able to do on your behalf. You have to make them. And so that's when I realized, oh, okay, a lot of the people involved in the slow money movement may not fully appreciate the risk involved in those type of activities, which are great. You're supporting the local economy, but there are risks associated with it. And so I started developing, a course to understand, the risk, how to do due diligence, and also how to carve out a slice of the portfolio that you can use for those type of really, I would call, deep impact investments, things that you really care about, that you want to support, but may or may not return the capital back. And so this is what I call the regenerative investing, which is in between philanthropy and investing proper, which is you're not that concerned about the financial returns. In fact, you're not even that concerned with the money all coming back, but you really care about what you're trying to support.
For context, can you provide us a little more clarity around social responsible investing versus ESG investing versus slow money, and what you feel is a good way to invest one's money?
Well, a good starting point, of course, is go to ESG investing. Now, ESG, I think, is the socially responsible investing movement, I think, started with faith institutions that did not want to have their pension money invested in tobacco, alcohol, and gambling. I think that was like the origin of it. So basically, what they were doing is they were looking at the individual stocks and say, well, we're not going to hold. We don't want to own any of those stocks in those three industries. And then this evolved as a series of screening criteria. So you could have fossil fuel free funds. You can have weapons free funds and so on. Now ESG has been an evolution of that socially responsible investing screening of the time. And they clarified that there are actually three areas that you're looking at. One is the environmental impacts of the companies. The other one is the governance, how well they're run. And the other one is social, which is both how they treat their employees and the community at large and the suppliers and so on. So ESG is certainly a great first step. There's no reason why people would have traditional funds. And again, if you think about an index fund, great idea, super cheap, you own everything. So all the bad boys, they're all there, right? So of course, the first step is ESG funds, and that's great. You can work with your financial advisors on that. But it's still not aware. So I have a different classification for investing. I have the first step for me, is unaware investing, which is most of the investment we make. We don't really know what we own. So aware investing is where your money is. So for example, you could say, okay, a treasury bond or Tesla or Apple, it's aware investing. You know where your money is. Now, for the next step, which is it no harm? That is a little bit subjective. So you could say, well, Apple, of course, is no harm, right? Is a company that does these beautiful products. I buy their phones every year, and it's, beautiful objects. Another person could say, well, let's look at how those phones are made. Let's look at the business model that basically calls for obsolescence and all this electronic waste being created worldwide. Is that no harm, right? So the issue of what is harm or no harm is subjective.
Yeah, and there's been attention to their subcontract manufacturers. The laborers are under intense pressure. So is that a good working environment? There are so many different variables.
Right, exactly. So, and again, people can make their own decision, even in terms of, U.S. treasuries, right? U.S. Treasury, you're thinking, well, where the money is it harm or no harm? And that depends on your interpretation of about half of what the government spends in defense. So are we really defending ourselves? Are we being attacked in all the 100+ countries where we have military bases? Or are we engaging in, war of choices and wars of choice or other military, adventurism? So that's, again, something that people would need to make their own decision about. Now, the next category is what I call impact investing, although I don't like the term impact for a couple of reasons, one of which is some impact investments are actually unaware. So, and could be harming. So I know, for example, of some solar investments in Mexico that, displaced some indigenous populations, provided no benefits to the local community, but it was, solar power. So went under the rubric of impact investing. To me, that term impact investment mean that the investment is aware and it's doing no harm and it's trying to solve some social or environmental problem, and it has a positive risk-adjusted return. So at the end of the day, you are expecting your capital back and a return, potentially concessionary. It could be a smaller return than you would otherwise get. And then the last category, which is in between investing and philanthropy, is what I call the regenerative investing, where you put in more money than you take out. Some of the slow money investments are like that. You expect to maybe lose a little bit more than you get back. So if you make a loan to a farmer for 3% or 5%, there's more than a 5% chance you're not going to see your money back. So on a risk adjusted return basis, it may be a negative risk adjusted return, but you still do it because it's important. So that's maybe more than you wanted to hear from me.
No, that's helpful. And I saw that for you, you want to apply this kind of moral compass to your investing. And as a first kind of filter, I heard the term biophilia. And you want your investments to be supportive of conditions that are conducive to life, not the opposite. Do investors need to go through a process to really clarify what is one's values first? Because I think that's going to vary from individual to individual. Some people want more governance, right? They want women represented on the board or minorities on a board of directors. Others, it's environment.
Right. Yeah. So that's why there is this concept of building your own personal investment compass. This is an idea that I got from my friend Amy Pearl up in Portland, Oregon. And the idea is that you sit down and you ask yourself, what are the things you want to see happening in the world? What are the things you really care about? And especially, what are the activities you don't want to participate with your investments, right? And you clarify that. Now, for me, I've distilled everything down to two criteria. One is biophilia, as you said, the love for everything that is alive and trying to support the conditions conducive to life. And the other one is empathy, which is, if I get a financial return, I don't want that to come at the expense of other people or workers not being paid a living wage and so on. So I really start there. And then typically what I do is I establish a relationship either with the entrepreneur that is asking for money or with the fund manager that is managing my money. In the case of RSF Social Finance, I know a lot of people there. I know, their criteria, I know their values and so on. And then only after that, I might consider an investment. So, but people care about different things. Some people care about polar bears. Some people care about women and girls around the world. Some people care about, displaced populations or immigrants. So, it's good to clarify and then to ask yourself, are my investments in conflict with that or not? And again, that's actually a hard thing to know because we live in such an intermediated and opaque financial world.
Marco, what's a good starting point? Because you educate a lot of people, individuals, other advisors, you talk to different institutions. What are some of the mindset shifts that people need to make, and where do they begin? Because it just seems like in this financial world of a lot of complex products, many individuals, they don't even understand the difference between one mutual fund and one exchange traded fund. Some of these subtleties, they don't know. But you're then on top of that telling them you need to do more homework because just the structure isn't good enough. You need to really dig under the hood to understand what's happening, because if we own Cisco or we own some company that we don't realize is in the S&P 500, we're kind of complicit with a larger problem that we may not even realize.
Right. Well, the first thing I want to say is that be easy on yourself. We're part of a system that makes us do things that might be naughty and without even us knowing it. So that's the system is designed that way. I want to give an analogy. If you think about the food system we have, industrial food system has made it really easy for us to feed ourselves very cheaply. And the apotheosis of that, the best example is the TV dinner, right? You slap the TV dinner in a microwave oven, you eat it in front of the TV, you don't even have to wash dishes, you toss the whole thing and you're good. Super convenient, super easy. Now, what is the flip side of that easy and convenient way of feeding ourselves? Is that we're getting really sick, right? We're getting obese, we're getting all sorts of problems. And the reason is that because we really need to know what we're putting in our bodies. And so now, people are advised to read the labels and know what the ingredients are. And is it highly processed food? And of course, one rule would be, take a can of something, read the ingredients. If you don't understand half of them, don't eat it, right? Or even better, if they have nothing on the label and you have no idea what is inside, you don't want to put it in your body. So the same thing is for the financial products, right? We have super complex financial products, and sometimes we don't even know what is inside, right? But now, continuing to feed ourselves out of those opaque financial products are now compromising our collective health, the health of our communities, of society, and the ecosystems. So the idea is that try to find things that you can understand. And if a financial product is so complex that you don't know what is inside and your financial advisor doesn't quite know what is inside, don't buy it. That's why I like RSF Social Finance, is that you can list, you'll see all the companies that they invested in, and it's super cool. You'll feel great about it. For example, I sometimes go to a meditation center, not in the last year because of COVID, but it's called Spirit Rock Meditation Center in the Bay Area. It's a beautiful center. And the big building, the new community building that they built in the last couple of years, was financed by RSF Social Finance. So you see, concretely what your money is doing out there in the world. And again, it's hard to be perfect. You can start with ESG funds, but if you don't understand a particular product, financial product, probably it's extractive. Probably there is something to hide, right? It's maybe too complex, and the complexity usually benefits the financial industry itself, not necessarily the investors.
Unfortunately, that is all too often true. So do you recommend, as an initial step, looking at ESG funds, and then as one educates him or herself, they can go deeper and try different things? I'm curious, since you mentioned that you don't have any publicly traded companies in your portfolio, what does your portfolio look like?
My portfolio looks like, half of it is no harm. And I do have an investment manager that is doing single bond transactions. So they invest in things like senior living centers and schools and so on. And these are like unrated bonds, and they buy the whole bond. So they meet with the team, they see what their project is, and then they say, okay, we'll buy the whole bond, let's say 20 to 30 million, and then they divide it up among the clients.
So good transparency into the underlying investment.
Exactly. So you know exactly what bonds, and in fact, you have the choice as an investor to say, yes, I want to be part of this bond or not. But it's all no harm stuff. So from schools, charter schools, and senior living facilities, in my view, that's no harm.
And you can do some due diligence still, because you can look at, what is the financial strength and likelihood that the loan will be repaid.
Sure. I mean, that's what this investment management firm is good at. They have a fabulous track record in terms of, their information ratio, the return based on the level of risk. So anyhow, but that's a portion of my portfolio. I have a fairly large chunk in cash or cash equivalent, like RSF Social Finance. There's another company that I would like to mention. This is an impact investment available to everybody. And it's CNote. I don't know if you know about CNote.
I do not know about CNote.
So if you go to mycnote.com, a friend of mine, Kat Berman, and a colleague started this company to raise funds through the internet and fund CDFIs around the world, around the country, that are supporting minority women and minority entrepreneurs. So CDFIs are community development finance institutions that are trying to provide capital to populations that have a hard time accessing capital. And not surprising, these are mostly minority entrepreneurs and women. And so people can participate in CNote. They pay around 2.5%. There is a quarterly liquidity. Is quite safe because they invest in turns in this CDFIs that have been around for a long time and had really good track record. and you're supporting minority and women entrepreneurs around the country. So I have a good portion of my portfolio is in cash-like investments like this, and then a lot of slow money and direct investments and early stage investments and so on. So it come tax time is a little bit of a problem, I must say. But yeah, I wouldn't go overboard. I made too many of those small investments, and I think I have like 40 or 50 things that I keep track of, and that's too much. But it can be simplified.
Marco, in your experience, is there an opportunity cost in performance, or are you measuring performance in a different way than you did previously?
Well, I think one thing we need to realize is what is enough, right? And there is an interesting book I read a few years ago called Richistan by, I don't know if you read Richistan.
I haven't read that one.
Enjoyed. It's by Robert Frank, and he is, well, I don't know if he's still working, but he was at the time a Wall Street journalist, and he was fascinated by the rich. So he interviewed all these rich people, and he classified them in three groups. There were the poor rich. Those are the people that had 10 million to 100 million to their names. Those are like the poor rich. And then there's the middle class rich, and they had between 100 million and $1 billion. And then there were the rich that had $1 billion or more, right? So picture that. And he asked them a lot of questions. And one of the questions, interestingly enough, was, do you feel financially secure? And if not, what would you need to have to feel financially secure? So put yourself in the shoes of, the rich. It turns out that if you have $1 billion or more, you're financially secure. So good to know, right? But everybody else, so the poor rich and the middle class rich, they said they did not feel financially secure, but they thought if they had twice as much, they would feel financially secure. So if somebody had $10 million, no, they didn't feel financially secure, but with 20, they thought they would. But then you ask the people that have 20, and they did not feel financially secure, but they thought with 40, they would feel financially secure. You ask a person with $100 million, and they didn't feel financially secure, but they thought with 200 they would. So if you do not develop a sense of enough, there is no financial return that would get you to feel financially secure, because it's not a number. At a certain point, it's not a number, right? It's really a psychological thing. So I am looking at my lifestyle, which is very modest, and I look at the things I really enjoy doing, what I want to do, and it turns out that I have enough. And of course, I need to work a little bit because my portfolio doesn't generate a lot, but it generates a little bit, and that's fine with me. So I don't really have any benchmark. Like, I don't look at the stock market. I don't care. Actually, my view of the stock market is that it's a factory of regrets, because it doesn't matter what you do. You could have done better. You could have lost less. You could have bought Tesla earlier, or you could have sold it the peak, right? I mean, it's like there is always regrets with the market. So I don't look at the market. I just look at what do I need, and what is enough, and how to get there. And so if people develop that sense of enough, it's much easier to manage one's financial affairs, because there isn't this drive to say, oh, I need the maximum possible legal return I can get, right? Because what? You're never going to be feeling financially secure, because if, millionaires don't feel secure.
It's the curse of a moving target.
Yeah.
Since you're involved with this slow money movement, and there's a belief that there's such thing as money being too fast, and companies being too big, and finance that is too complex, do you find that there is peace of mind in focusing on slow money and local business?
Well, I feel really good at night knowing that I know all my money is placed in ways that I approve of, and that is not extracting from the environment and other people. So it feels really great to know that I'm not participating in the erosion of the environment or of society through my investments. And it's actually, unfortunately, a very easy thing to do. Now, moreover, think about how cool it is to walk downtown and know that your beloved cafe or bakery is still in operation because at one point you loaned them some money, or your favorite farmer is still delivering you boxes of food every week because you helped them along. So there is something really rewarding about line of sight investing, where you know exactly what your money is doing out there and you approve of it. I mean, one of the things that I'm particularly pleased with is my investment with Community Foods Market in West Oakland. By opening this full service grocery store a year and a half ago, we eliminated a food desert in West Oakland. Now, we still don't know if we're going to be successful, if we can reach profitability, if we can keep this thing going, because as you might imagine, during COVID, that population has been hit so hard, both in terms of employment and in terms of health. But nevertheless, that's one of the most rewarding investments I've made. And I might lose it all, and it doesn't matter.
Marco, I'd like to ask all the Inspired Money guests, how do you define success?
I define success as charting your own path in life, reaching a sense of enough, using your time as you see fit, and being engaged in meaningful activities. So that's my definition of success.
I like it. Well, thank you for sharing your personal and professional story with us. And indeed, you are living inspired money from my perspective, because you want to know that every dollar that you have is being spent or invested in alignment with your values. So thank you for sharing with us. And can you tell the Inspired Money listener where they can follow you, learn more about the organizations that you're involved with?
Oh, sure. I have something called Essential Knowledge for Transition. So I have a little website. It's ek4t.com. They can check out my website. And I'm offering a course starting in May called Towards Aware No Harm Investing for individual investors, if they want to learn more about the space of no harm and aware investing. And so they can find that on my website in what we do in courses. Take a look at that.
That's great. Thanks so much, Marco.
Yeah, thank you for having me, Andy. I really enjoyed it.
So what was your favorite Inspired Money moment? I'm not sure if there are any billionaires out there watching. If you are one, this may not apply to you. My favorite Inspired Money moment was if you do not develop a sense of enough, there's no financial return that will get you to feel financially secure, because it's not a number. It's really a psychological thing. If you had a different favorite Inspired Money moment, please let me know by posting a comment below. For watching until the end, thank you for watching the whole thing. I want to send you an Inspired Money sticker or a button. Go to inspiredmoney.fm/Andy. That's inspiredmoney.fm/ANDY. Send me your name and address, and I will send you real mail. Thank you so much for joining me on this mission. Have an inspired week and do something that scares you, because that's where the magic happens.